Hey, Think Realty listener and viewer, thank you so much for joining the podcast. We're coming to you live from Tampa, Florida. As always, every time we have an event, we love to do our podcast live. It's way better to have that personal interaction with people live as opposed to trying to do Zoom. It's just, Zoom's a great tool, but man, I'm so tired of doing that. That's why I make Abhi Golhar always do the Zoom calls. I get to the live ones, and we'll get to our live guests in just a second. I want to say a quick thank you to our podcast sponsor, which is Rent to Retirement. Does 20% return investing on turnkey rentals sound attractive? Of course it does. Rent to Retirement offers fully turnkey properties that are newly built or renovated, leased and managed, allowing you to invest with confidence out of state. They have single family, multifamily, and new builds across 15 markets that maximize cash flow, appreciation, and equity. Rent to Retirement helps investors build a business plan to achieve financial freedom through real estate investing. To learn more, go to renttoretirement.com. That's renttoretirement.com. Our guest today has been a longtime supporter of Think Realty, and we appreciate Ashcroft Capital. Travis, it's good to have you on the show today.
Nice to be here, as you said, in person.
Yeah.
And more importantly, in Tampa, because I live in Orlando.
Yeah, so that's not too far of a drive,
hop,
right?
skip, and a jump.
Is it I-4 that you drive over? That's not too bad of a drive, right?
No, pretty much a straight shot.
You get to come through like the heartland of Florida, right? Like Lakeland and all those areas. Yeah, cool. Very cool. Glad you came over today. So let's jump in. We know that the marketplace is kind of crazy today, right? I mean, interest rates rising, an impending interest rate rise here again in the near future.
Yep.
You've got a lot of consumer sentiment that's dropping. It's weird stats. I mean, like we're still 6.5 million homes underbuilt. There's a ton of demand in the marketplace still.
Yep.
There's a lot of demand for affordable housing.
Yep.
Even if interest rates go up another quarter or 0.75%, we're still under where we were in the Obama administration. It's like, I think people kind of forget about that. Like it wasn't 10 years ago and we were at that rate or higher.
Yeah.
But it's that consumer confidence issue, right?
Yeah.
Like it's the stats kind of point to there's no reason we really should be in a recession other than maybe inflation or the cost of housing. But employment isn't low enough to really be called a recession, right? The American consumer is making $1,300 more than they did during the Obama administration when our interest rates were higher, right?
Yeah.
And everybody's like, well, but inflation, we're losing $450 a month, per family. And it's like, yeah, but if you kind of like play all these stats out, it's like they kind of point to this really weird place we're in.
True.
And so I know you're invested heavily in multifamily, and you help real estate investors get into multifamily. Talk to me about, with all the craziness in the market, what's going on with multifamily? What do you see happening? Are there still deals on the street? Is there still opportunity?
Sure, yeah, absolutely. So I'll start that with a story, and the story is I wanted to be an investor for a very long time. Even as a child, I wanted to be an investor, which is weird. And so starting as a lot of people start with single family homes and reading Robert Kiyosaki books and kind of the gateways to the industry, I eventually found a mentor, and he was a gentleman that sold his business in 1995, made millions of dollars unexpectedly, and had to become a full-time investor.
Sure.
So I'm picking his brain. This was at a real estate meetup out in Colorado, 2015-ish. And he tells me, my bread and butter to my portfolio has been multifamily private placements. And I had no idea what that meant.
Sure.
And so as we dug into it, it turned out it was value add, class B for the most part. And so I'm a pretty macro level guy. So to your point with interest rates, I'm the guy that's looking at like that 50-year chart, and I'm saying we're still at extremely historic lows. We could go up 3%, and it's still not crazy. You listen to Kiyosaki talk about doing real estate multifamily deals with 20% interest rates. So I'm an advocate of this, and this comes from my childhood. My parents raised me very frugally, and it was always buy a fixer-upper and make it better and sell it at a profit. We did this with cars. We did this with clothing. We did this with our own houses. And so that's kind of what led me in. So that's the backstory. But to answer your question, what's going on? Well, yeah, obviously rising rates is always a negative, right? But also to your point earlier, severe lack of inventory. Who doesn't need affordable housing in America? You can't afford to build it at prices that we rent for. We're talking about $1,100-1,200 a month, two-bedroom units. So I like to be in something that's essential. I'm not the guy chasing, the crazy crypto stuff, and nothing against crypto. It's just the fundamentals really aren't there. The historics really aren't there. The macro level's not really there. So that's not the right fit for me.
Yeah.
So I think there's still a ton of institutional buying, obviously. There's a lot of retail buying. That's compressed cap rates. That's increased pricing. And there's lack of inventory.
Right.
So even as we're seeing rising rates, I was just watching a Marcus and Millichap kind of recap, and there's still historic demand for the asset class.
Right.
So we're not seeing these major 2008 kind of movements and stuff like that. So are there deals still to be had? Yes. Are there a lot fewer than maybe 5-6 years ago? Yes. But we got to be patient, and you got to make sure that the numbers work, obviously, or it's not worth doing the deal.
Yeah, I was talking to a very large hedge fund manager the other day. And he said we've gotten to a place, he said, where to mitigate risk, we have to create more doors in the portfolio, and which is not what the average real estate investor is thinking right now. They're thinking, oh, more doors brings more liability. They've got to change their mindset a little bit, because what he said is if I can't buy a 150 door single family portfolio, I'm just going to go buy more multi, right? It's like, because what he was saying is like, what happens is the fundamentals of real estate. The more renters you have, the less risk you have, right?
Yeah.
Because the guy that has, and that's why it took me forever to get into the commercial space, because it was like, well, if I spend $5 million in this commercial building and I only have one tenant, and that one tenant goes away, and I sit on this property for 3 years with all this debt service, like, that's a really big problem, you know? And until my portfolio could substantiate a big commercial purchase like that, then it just didn't make sense.
Yeah.
And a lot of these single family, they've amassed like 20, 30, 40, 50 doors now in the Think Realty space. And if they kind of took a note from some of the bigger investors, the institutional guys, they're like, no, don't buy 10 more single. Somehow get into 150 doors of multi, because you're essentially spreading risk over that many, that many customers essentially.
Right.
What are your thoughts on? I mean, I know that you guys primarily deal in Class B, like you talked about, value add. In those Sunbelt states, right? I mean, you said that you're in Florida, Georgia, a little bit of Texas.
Correct.
Yeah, and which obviously right now you've got 3 states that are losing people in a drastic rate, and that's New York, Illinois, and California. And you have 2 states that are gaining all those people, and that's Florida and Texas, right? I mean, so it's like you're kind of right in the middle of all of that population movement as well. However, there's been a lot of speculation and media about the Class A space. You got a bunch of really well-known guys out there that are just raising huge amounts of capital for Class A, and they're doing Class A builds. There's a lot of speculation out there that could be the one bubble that is most dangerous to ride today, because as people's affordability decrease, it's like the single-family home buyer. We don't buy houses. We don't go, oh, I need 3 bedrooms and 2 baths of 1,500 square feet for my family. What we do is we're entitled consumers. We go, I deserve a house that's typically outside of my price range, and I'm supposed to be spending, at least a half, 1/3 to a half of all of my monthly income on my house. So therefore, I deserve this place of whatever my monthly payment can afford.
Sure.
That's how the American consumer buys today, right?
Yeah, right.
They don't even care what the price of it is. They just want to know, well, how much is my monthly payment? That's how we buy, and by and large. However, we're reducing what the American population can actually spend on a monthly basis. Yeah. And the guy that could have spent $2,500 in an apartment for granite and all the big amenities and the, the massive pool and the Class A stuff. Yeah. They're going to be squeezed down because of inflation, because of all the, all of that. So where do they go? Well, there's only really one place to go, right? If you're already in an apartment complex, you're not going to be able to afford a rental on a single family. Those are essentially non-existent across America today. It's too hard to get them. Build to rents, as much as there's fanfare around it, like there's limited liability unless you're in a big urban, marketplace. So where do they go? They go to Class B, right? And then they're probably going to go to the nicest Class B that they can afford, which is exactly what you're talking about, value add. Is that kind of what do you believe that? Do you believe the speculation that maybe the real bubble is the Class A, that the Class A apartment complex that's at a 2 or 3 or 4 cap, but is really going to be unaffordable?
I think that depends, because Class A, meaning luxury and high-end and new development, could mean a lot of things. So in markets like you described earlier, when you talk about Illinois or downtown city centers, San Francisco, you know, et cetera, you're talking about $5,000, $6,000 a month rent.
Sure.
Yeah, obviously that gets impacted by anyone that's had that executive or VP level job that now is stepping down. But it all gets back to, again, the macro level. I want to be where most people are as far as the demand goes.
Sure.
You know, so that's why the Class B. And yeah, you brought up great points. And so you look at discretionary spending, you look at average savings rates, you know, you look at potential layoffs, which are already happening. And so you still want to be in that most affordable space, in my opinion. You know, car repos are starting to go up again. I mean, and again, one more like flashback to the macro, every asset class goes through a cycle.
Sure.
And so if you're going to be a long-term and a professional investor, you have to think about that. And something that happened between 2007 and 2009 and the Great Recession with commercial multifamily is that as soon as the onset happened and the panic was at its all-time high, your vacancies fell in the Class B sector by about 10%.
Sure.
And then they quickly rebounded for reasons that you're talking about. What happened? People lost homes. Where did they go?
Right.
Rentals. Class B was most people's spot at that time. So you may suffer for 6 to 12 months, but if you're holding for positive cash flow and you're holding more than 6 to 12 months, then you can weather the storm a lot better.
Sure, yeah, that's a great point. When it comes to underwriting, you know, and I know that you probably take on a lot of LPs or passives in the deals that you're doing, so they're depending on you to underwrite these deals and make sure it makes sense for them. Has your underwriting criteria changed at all over the past 6-8 weeks? You know, are you making adjustments there because of the economy?
I would say it started changing with the onset of the pandemic. Okay. So we were actually closed, we're here in Tampa talking, and we closed a deal, doing a property tour tonight on it, right as the onset. This was like March and April of 2020. We backed out of that deal. And then we were able to renegotiate. We got about a $2 million discount. We took the LTV down, and we ended up entering back into it and closing it.
Okay.
You know, so our criteria changed there with really looking at, you know, exit cap rates and really looking at what we're telling our investors we're going to do for preferred returns and all the rest. We just like to underpromise and overdeliver, and that had a lot to do with, you know, my role as investor relations was educating the LPs that what we expected the last 3, 4, 5 years is not going to be the same kind of thing. A lot of people at that time were still, I want to enter a deal, I want 8 to 10% annualized cash flow out of the gate, I want to double my money in 3 to 5 years. It may not be that, and so we have to all adjust, and we have to look at, if you don't do a deal like this, then what is your alternative? And when you get realistic and you look at the stock market and a potential pending recession at some point, you think, okay, maybe I'll take a little bit less of a coupon to play the safety game.
Yeah, absolutely. And in an asset class that has a lot of runway and a lot of appreciation potential. When you look at these deals, you know, by and large, a lot of the Class B, Class C value add stuff that I've gotten into, the strategy was similar, right? It's buy-in, a lot of the rehab costs is built into whatever they raised. A refinance period of 2 to 3 years in where you get, you know, some of your capital back, maybe all of your capital back in great situations. And then kind of an exit pathway in 5, 6, 7 years down the road. Does that change at all? Like just kind of the fundamental process for value add is, you know, does that change? Do you have to underwrite to make sure that the cash flow is important in case you hold on it to 8 or 9 or 10 years? I mean, like, is there any of that changing?
I like to invest in deals that don't project upfront when or what a refinance is going to entail. Because nobody has control over the Fed, the government, you know, what's going to happen there. So I like to just look at historic cash flow, current cash flow, how much undervalued as far as the rents are concerned they are today, and what's realistic for coming up. So I always do my own due diligence as an LP investor. I'm on apartments.com and things like that. And I'm always like, it's trust but verify. The beauty of being an LP is that you can rely on the GP to do the homework, but you shouldn't just blindly say, oh yeah, whatever you say, I'm sure you looked into it. I'm always doing a little Google drive-bys and stuff like that. So that's one thing. The other thing that's changed, to answer your question, is that we were finding 100% value add deals 5 years ago, and even 4 years ago, and maybe 3.5 years ago. The deals we buy today have mostly been either partially renovated, half renovated, 3/4 renovated. So it's not the same value add opportunity that we had then, which again plays into the returns and the realistic expectations.
Yeah. So you're looking more for this long-term kind of cash flowing asset that maybe the lift isn't quite as heavy. It's underperforming, but it doesn't need like a complete overhaul for reperformance.
Yeah.
It's a little bit less of a lift.
Yeah, and what I'm seeing, again, just speaking as an LP this year and last year a little bit, is a lot of these deals are coming full cycle early because of what the market's done. They're now outperforming their projections. So I'm always telling investors to not expect that in the future. As we potentially go to recession or things change in the economy, we may actually hold 5 years. It may be 7 years, you know, and again, that's something to consider as a risk as an LP. You're subject to what the GP thinks is the right move.
Right. Yeah, and long term, and I'm sitting in a couple of deals that I've been in for 9-10 years, and I'm ready to exit because I got all this equity, you know. But he's, you know, the GP who has a lot of skin in the game is struggling to find his next deal, and so he takes this massive tax hit if he does sell, and so there's all this conversation like, should you refinance all the LPs out, or how does this work, you know, like, and you're kind of at the discretion of the GP. Couple more questions like in that line of thinking, but before we get there, like, how does Ashcroft work, right? So an investor's thinking about what we're talking about and they're going, yeah, that sounds interesting to me, I'd like to find out more. How does the structure work? How do they get involved? What's the services you provide to investors?
Yeah, so we started doing funds a couple of years ago. So we're on Fund 2 right now. It's called the Ashcroft Capital Value Add Fund 2. We target about 6 to 10 properties per year. You know, that's just our projection. And then we're in the Sun Belt markets. So as you pointed out, mostly Texas, Florida, and Georgia. And so everything we buy is stabilized and cash flowing day one, okay? And then we do monthly distributions for our investors. The actual legal structure is an LP, and then we create a brand new LLC for each property that's acquired, with 100% owner being the limited partnership, which is the fund. So what's nice about that, again, speaking as an LP, you can invest most of the year. It's first come, first serve, but like last year we launched, I don't know, into January and closed early December, so that was a good portion of a year. So if you have other deals that are selling or you want to take some chips off the table, you know you have a place to roll into, you know, throughout the year. So 1K1, which is nice too, makes it very easy and streamlined. So that's what we do. 5-year holds approximately, value add business plans, 200 to 600 units in size, and garden level mostly.
Got it. That makes a lot of sense. And so if they want to reach out to you, it's Ashcroft Capital ashcroftcapital.com/Travis to get to you?
I got a landing page there, one-on-one calls, no sales pitch. Got some downloadable PDFs, and you can check out current offerings there.
So when you get into the more sophisticated, so we talked a little bit about like somebody that comes in at 50, 100 grand, whatever that is an LP position. There's people like me and others that are, you know, out there that we produce a lot of non-W2 income, and the strategies that we have are typically on a tax avoidance, right? And so, or limiting our tax liability. And so we don't typically like play at the level of like, what's my cash on cash return? It's typically like, yeah, can I get a solid return, but then can you cost seg it, and can you give me the pass-through depreciation, because I'm just trying to offset all this other capital over here in taxation. And then our aggregated net on the property could be 19, 20, 25% in return, because essentially it's offsetting our massive tax liability. Do you guys ever get into that like deep of a strategy with somebody and trying to make sure they're maximizing their depreciation and things like that?
Sure. I mean, obviously with the caveats of not financial advisors, not CPAs, not attorneys, but yeah, we do cost seg studies on every single property. As I mentioned, it's a consolidated composite K1 at the end of the year. 2022 is the last year of the 100% bonus depreciation, at least for now. So it's still a great time. You know, roughly, I mean, just some rough numbers, speaking personally, not on behalf of Ashcroft, but, you know, your K1s are usually like a 50% loss on paper in year number one. So it's still very tax advantaged as an asset class. Real estate really has been. You look throughout the whole globe, I mean, real estate's usually that. It's a tax favored investment class. It's because the government needs housing to be provided. They're not building the houses, you know, and providing it. So it's just an incentive. So
very good. I think that's a huge thing. Is like I know that there's a lot of there's a lot of high net worths in Think Realty that I think they think about investing one-dimensionally. And when you get to a place where you are a high net worth, I often find that you make this switch. And the switch is like you talked about being a professional investor, but sometimes I spend more time trying to avoid tax and capital gains than I do actually trying to find new great deals. You know, like I have a bunch of companies, they all kick off non-W2 income. Yeah. It becomes, it's a great burden, but it's a burden, and so you either just pay 40% of it to the government and you walk on and go, okay, well, that was good, or you find investment opportunities to grow your net worth and avoid, or compensate for the tax loss. But anyways, I think I feel like multifamily is one of the greatest strategies for that. It's an easier place to deploy larger amounts of capital, which allows you to typically depreciate larger amounts of a larger valued asset. And then, like you said, you get to take these typically good hits right up front with the loss in the beginning in year one. So pretty solid opportunity. I
didn't get into real estate for the tax reasons, but I ended up like you, it becomes a bigger and bigger thing, as you all know, I'm sure. I mean, the more income you're generating, the higher your tax bracket. You get a lot of Californians, people in New York, sometimes paying 60% tax. And not just talking about federal, but of course the state income tax and any local taxes on top of that, self-employment taxes. It gets really rough. And so, to your point, it ends up being the difference between a 8% return, non-tax favored, or 6% highly tax favored. Sometimes 6 makes sense.
What I recommend is, whether or not somebody is like ready to get into multifamily or not, is to at least reach out and make the contact, make a relationship with everybody that's a solid operator, right? Because for me, I've utilized 1031s periodically when it makes sense. But the biggest issue with 1031s is finding the next deal to get into. And so the biggest issue is when you start to think about the disposition of an asset, you better have a whole bullpen of people that are out there that you could put capital into, such as yourself, where you're like, hey, what do you have? Is it solid? Is it a good investment? Because I found myself between those two positions, like I've got a great buyer, but it doesn't make sense for me to sell if I can't 1031, because I'm going to lose 39.6% of this asset if I sell it, and without rolling it in. So there's a lot of strategies around that, but I think it's so important that the viewer gets to know you and others that are in our world that are either deal sponsors or people that can put deals together, good operators. Because in the end, you need a bullpen. Like it's hard to go, this is my only guy I'm ever going to do multifamily. Now, I have people that I've done stuff with a long time, and you get that level of confidence where it's like, if they have a good deal, you kind of just get in on it, because which I'm sure you've got a lot of those. But also, it's like we all should be keeping our head up going, who else is a good operator? Who else has the deal? Who else has these opportunities? Because all of us should consider them, Huge advocate for diversification. For sure. For a new investor, maybe they're just in single family, they're considering multifamily. What's a piece of advice that you might give them?
Oh man, so my journey was all the single family stuff, flips, vacation rentals, buy and holds, flipping homes that I lived in every couple years, stuff like that. I just got concerned that one day I'm going to wake up, have 50 properties all within a 30-mile radius, and political risk, tax risk, natural disaster risk. So there were so many markets I was interested in, but the pathway to buying single family out of state just seemed a bit overwhelming, too logistical. I was a very busy W-2, and so I would just think about the scalability of doing private placement investing, because that allowed me to get into the markets that we talk about today, and many more markets on top of that. Because there is no perfect market. And so I'm the guy that's doing the 50K there and 100K there all over the nation, for that reason. That's so great. Think about scalability. Like with Ashcroft right now, we just built out some warehouses in Dallas-Fort Worth because of the supply chain issue. We're buying literally thousands of appliances at a time. Think about the discounts that you get from that versus owning your single family home, running down to Home Depot, paying above market, especially right now. And it just makes a lot of sense to me to buy things cheaper that way, and to do it where you could lose 15, 20 tenants could turn and move tomorrow, and you're still cash flow positive in your single family home. One tenant's out, you're not only zero, you're negative, right? You still owe HOA, property tax, insurance, and you got to find a new tenant.
That's a great point. Thanks so much for being a part of the podcast today. It's been great to get to know you a little bit better and hear a little bit more about Ashcroft. Again, you go to ashcroftcapital.com/Travis. You guys also do social media and things like that. Can they find Ashcroft on social?
You can follow me at Passive Investor Tips on social media, Instagram and Facebook, or Travis Watts, WATTS.
Passive Investor Tips. Very cool.
There you go.
I like it. Very good. Well, thank you so much for joining us today. I really appreciate it.
Yep. Thanks, Eddie.
Let me say a quick thank you again to our podcast sponsor. Podcast sponsor is Rent to Retirement. Rent to Retirement offers full turnkey properties that are newly built or renovated, leased and managed, allowing you to invest with confidence out of state. They have a single family, multifamily, and new builds across 15 markets that maximize cash flow, appreciation, and equity. Rent to Retirement helps investors to build a business plan to achieve financial freedom through real estate investing. You can learn more at renttoretirement.com. That's renttoretirement.com. I just want to give you a quick word of advice, Think Realty listener, viewer. As the founder of Think Realty, we created Think Realty to be the companion of the real estate investor, making sure we put the right data in front of you and the right people in front of you. The marketplace is crazy right now. We all know that. Interest rates rising, a pending interest rate increase here in the near future, and who knows where the marketplace goes. Whether we go into a recession, whether they hold it off, there's so much unknown. So what you need to do is immerse yourself in data. You need to make sure that you are following people that are actually doing deals. This is not a time necessarily to buy education from people that are speculative in what they're teaching. You should follow the people that are actually doing it and follow them and make sure that they have expertise and knowledge in that space. And number 3, we should be looking for the next opportunity. The next opportunity may come in diversification. If you've been doing the same thing for the past 10 years, it may not be smart to do it for the next 10 years. You might want to consider diversification, something like multifamily or others, self-storage, whatever it is. Get data, get information, and start challenging yourself to get outside of that bubble that you've created. Because in this next market cycle, how you made money in the last market cycle may not be the best way to make the same money. And so follow Think Realty, be a part of our conversation. Let us know what you need. If you need more information on any asset class, we'll get the people in, we'll interview them, we'll bring the data to you. And you can find us at thinkrealty.com. You can follow us on all the socials, Instagram, Twitter, Facebook, LinkedIn, all those. And you can also pick up the latest Think Realty magazine on your local Barnes & Noble bookshelf, as well as pick it up by getting online and having it delivered to you. Thank you so much for being a part of the Think Realty universe. We appreciate you being a part, being a member, and following along. Please stay in touch. Let us know what you need, and we will be glad to serve you. Have a great day.